Welcome to CFA Level 1, Alternative Investment, Study Session 50. The alternative investment covers non-traditional investments, which are hedge fund, private equity, real estate, commodities, infrastructures, etc. Alternative investment has unique characteristics compared to traditional investment. Overall, A. Alternative investment has less liquidity. B. Require more specialization such as to the value and identify fine wine and fine art. C. The return has a low correlation with the traditional asset. D. The alternative investment is less regulated. E. Less regulated is also causing limited historical data. F. The investment is subject to unique legal and tax requirement. The return for the alternative investment, generally, has a lower correlation with traditional asset, higher and non-normal return. Alternative investment is subject to illiquidity risk. Non-normal return is making standard deviation and inappropriate valuation for risk. More appropriate risk quantification is to use VAR, Sortino ratio. Meanwhile, the leptokurtic, negative skewed curve in the return, is to use stress test and scenario analysis to measure the tail events. The hedge fund is actively managed fund, and use leverage takes long, short or derivatives to earn an attractive return. The unique nature also causes hedge fund subject to survivorship bias. Survivorship bias, those survivors and remained in the hedge fund business, would have been reported. A terminated hedge that does not survive, because of failing return has not been reported. Backfill bias occurs when, the return, especially well-performing one, has been reported at the discretion of hedge fund. The hedge fund has been loosely regulated, and give more flexibility for the hedge fund to disclose information. The hedge fund manager would impose restrictions such as the lockup period or notice period, as the condition to redeem investment. Transparency is generally limited, and therefore performance benchmark is to generate an absolute high return. Limited partner LP is the passive investor and do not participate in the investment. Meanwhile, general partner GP is the fund administrator. Fund of funds FOF is another form of hedge fund, in which it invests in multiple hedge fund of a portfolio hedge fund. It has a number of benefits, and because FOF invests in the hedge fund, investors to the hedge fund are subject to two layers of the fee. The first layer of the fee is charged by the FOF, and another layer of the fee is charged by the hedge fund invested by the FOF.
This type of question is to test your ability to recall the advantages and disadvantage of FOF. The different hedge fund would employ a different strategy to earn a higher return. The hedge fund would employ event-driven strategy, which hedge fund analyze the event and take an investment decision. For example, the hedge fund would focus on events in companies such as merger and arbitrage, distressed or restructuring events. This slide explains merge arbitrage would generally cause an increase in share price in the target company, and a decrease in share price for acquiring company. Such as in the case of Microsoft acquiring LinkedIn in 2016. The second type of hedge fund strategy is the relative value strategy that evaluates mispricing in related securities. For example, a hedge fund might take a long position in convertible share, and the short position is to common stock. Convertible share is less traded, and common stock is more traded, which cause mispricing to occur. The macro strategy is to evaluate the macroeconomic fundamental and to employ the strategy. The equity hedge is to employ different financial instruments such as options, long or short positions and invested in the equity market. For example, a hedge fund could take a long position in American Airline and short position in Delta Airline, to eliminate the industry impact or factor. That is known as market neutral strategy. The fees for hedge fund includes the management fee and an incentive fee. The important part is to know, incentive fee would subject to the hurdle rate. If hedge fund earning is below the hurdle rate, the hedge fund would not be granted the incentive. Incentive fee would subject to high water market, which would discuss in detail in next slide. The fees for hedge fund includes the management fee and an incentive fee. The important part is to know, incentive fee would subject to the hurdle rate. If hedge fund earning is below the hurdle rate, the hedge fund would not be granted the incentive. Incentive fee would subject to high water market, which would discuss in detail in next slide.
For example, The incentive for time period 3 is to compare the portfolio at time 3, V2 with the portfolio at time 1, V1 and multiply with the corresponding incentive rate. High water mark, prevent investors from being charged twice for the same level of performance. This practice problem is to calculate fee to hedge fund. In private equity, it is the investment to invest in a private company or to the public company into private. Private equity firm has some subcategories, including leverage buyout (LBO), venture capital, development capital and distressed investing. In the leveraged buyout, there are 3 types of financing capital to finance the acquisition. The financing channel includes mezzanine financing, leverage loan or high-yield bond. This slide is to explain company characteristics, which would be engaged by private equity for leverage buyout. For example, private company would survey undervalue company to proceed in leverage buyout. In the venture capital, it engages in primarily the early stage of company investment. If the investment based on ideal by the inventor, that is known as angel investing. The fee structure of private equity is similar to the hedge fund, except that the management fee is based on committed capital rather than the invested asset. Also, LP has the priority to receive initial investment, and subject to clawback provision. This slide is to highlight various exit strategies in private equity. In real estate investment, there are 3 forms of index measurements to measure real estate performance. In real estate investment, there are 3 forms of index measurements to measure real estate performance. In the commodities investment, it generally refers to investment on future contact of commodities. If the future price is greater than the spot price, it is known as contango. And if the future price is less than the spot price, it is known as backwardation. In the commodities return, it consists of the price return, collateral yield and roll yield. This question is to your understanding of various types of return in commodities. In the infrastructure investment, it is generally capital intensive and the infrastructure expected to last for a long time. In the infrastructure investment, it would have few characteristics such as high barrier of entry. Refurbished or improvement on existing infrastructure is known as brownfield investment. Greenfield investment is for new investment.